Let's talk to Clem Chambers from Investors Hub. Very good morning to you, Clem.
Good morning, Nick.
UK stock markets hit a 6-month high recently, whereas the political side of the UK hit a 43-year low. If you recall, in 1976, we went cap in hand to the IMF to bail out a loan. In terms of what's driving the UK markets at the moment, it's been suggested the US job numbers, some sort of potential deal with the US-China trade deal. The flip side to that is people are talking about potentially a global recession next year. However, shares are cheap. The FTSE dividend yield is 4.4%, way above the average yield of 3.3% since 1985. The S&P 500's dividend yield is just under 1.9%. However, the outflows in the UK, we've had 5 billion disappearing from the UK equity market in the last 4 months. However, the final thought for you, since the EU referendum in 2016, the FTSE's returned investors 31%, where the S&P is being the leader, it's actually returned 36% in that same period. What can you tell us about all of this data, okay? What would you be doing, okay? If you're a fund manager, a retail investor, a technical analyst, okay, would you be buying this market right here, right now?
You've got to buy this market. Brexit is dead, as I think most people understand now. So going to get no Brexit. I'm going to be a part of Europe forever. So that uncertainty is out of the way. That kick in the pants or in the teeth, depending on your point of view, is going to go away. So it's going to be increasingly safe to be in equities. I think the market's going back to all-time highs. It will now copy what America's done. America's in a sideways trade as the Fed continues to tighten, even though it says it's not, it is actually tightening. That will be a sideways trade for a year or two to come. But the FTSE's got catching up to do, and it will catch up now. So it's got another 7 or 8% in it in the next year at least. And it could go a lot higher, because if you look at the performance of the UK markets over the long term, it's way below the performance of the DAX. It's way below the performance of the American markets. And it should kind of catch up. The same goes for the French market. These two markets are really lagging the American and the German markets. And, you know, either the German markets and the American markets come tumbling down, which could happen, or the UK market and maybe even the French market will catch up, or a mixture of the two. But at the low end of valuation, without doubt, the FTSE's there. I mean, a 4.5% dividend, and we go to America, get none. So I think it's a very highly indicative sign of a cheap market. But the thing about expensive markets and cheap markets is the cheap markets keep getting cheaper and the expensive markets keep getting more expensive, because that's the way of the herd. But, you know, we could be near an inflection point, and I think that it's worth just sitting there for the dividend, frankly, and picking good, solid, long-term liquid companies with great dividends and just sitting on them and copping a 4, 5, 6, 7, 8% dividend off some of these big blue chips, because at some point the market will turn, and when you're getting paid 6, 7, 8% for your capital just to sit there, I think that's very tempting. In addition, obviously they should be paying 2, 3, 4% dividends. So there's a capital upside of 100% there over 2, 3, 4 years. So I think the UK market is very tasty now that Brexit's gone away. It hasn't gone away, but it has gone away. So the big call is, are we going to have a Brexit or are we not? And if you don't believe we're going to get a Brexit, like I believe now that Brexit is dead, then the UK markets will be on a little bit of a bull market just on that fact alone.
Clem, thank you very much indeed. That's Clem Chambers.
Thank you, Nick.